Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is May 28th, and we have Brent crude oil once again this morning. Little changed, really, just under $65 a barrel, 64.24 on Brent. It's been essentially stuck to that mid 60s mark. And now, after the sort of collapse in April, it seems to have settled at 65 and looking for new direction. Let's kick off this morning with David Weck, a chief economist at Vortexa. David, I wanted to look at the question of what might move it out of this range. And one thing that's grabbing my attention is that the debt markets, the bond markets seem to hate Trump's new bill, tax cut and debt raising bill. And we saw a big wobble in early May, early April. We saw the downgrade by Moody's in May on the US credit rating. Now we're seeing wobbles in the Japanese bond market. Is there something going on here that is of greater significance that the oil markets should be paying attention to?
I would argue that it's definitely the case that economists around the world and a lot of other market observers around the world are really concerned about the state and the fate of the US economy. Evidently, pretty much all these actions the Trump administration is taking have significant repercussions internally, but very often also significant repercussions externally. So yeah, the crucial question is how bad is the macro environment? I think the assumption in most places, I said before, is it's pretty bad. Is it already fully priced in? Difficult to say. I think we probably would need to see more evidence in the oil market that things are getting really badly. In our data, we have a pretty clear indication that basically oil deliveries at sea are constantly declining throughout this year. The arrivals of especially the key transportation fuels, jet, diesel, gasoline is trending lower, and it's a trend that goes constantly lower, but it's also not falling off a cliff. And if you look at the standard industry data sets, there have been downwards revisions to demand, but not yet to a level that it necessarily makes a huge difference. And everybody knows that the jury is still out. Yeah, we will only see that basically in the next couple of months, remainder of the year. That's also something that's pretty clear that this is something that is taking a time to phase in, and what we're seeing so far on the ground, on the water, is not necessarily yet reflecting all these actions of the Trump administration to the full extent. Yeah, so this is yet to come. So yeah, from all these points of view, there is a lot of concern. They may not be fully priced in, but we probably have to see more actual facts that the market goes really low. And of course, 65 is from a historical perspective. If we take, say now the history is 20 years or so, it's already a pretty low level. Yeah, and there is of course already factors coming in defending that price level, like reduced US shale activity, of course even though OPEC is currently showing type of different intention, but everybody knows that OPEC can, if they want, reduce the supply side and therefore
Yeah.
stabilize.
Robin Mills, CEO of Camar Energy. Robin, I'm trying to get at here whether this is something more structural. We're seeing a fairly significant story on Bloomberg today. They phrase it as their big take, and they're basically digging into the de-dollarization narrative that seems to be growing. And their headline is quite dramatic: Asia's $7.5 trillion bet on U.S. assets is suddenly unraveling. For decades, Asia's exports powerhouses its simple financial strategy: sell goods to the US and then invest its proceeds in the American assets, basically upending that logic. Your thoughts on this as a structural shift that the Trump policies are accelerating?
Yeah, thanks, Sean. I mean, Bloomberg seems to like its dramatic headlines these days, and likes to find a big picture story in everything. Not sure there always is a big picture story, but when we look at these kind of current shifts in currency regime like the one that we had after the end of the Second World War with the
But just on that point, Rob, just sorry to jump in on it. The Bloomberg big sort of dramatic headline has a sense of accelerating a self-fulfilling prophecy, right? I mean, the echo chamber of Bloomberg and Wall Street is quite substantial, and so something like this could early, accelerate a narrative that may not be wholly bedded in.
Yeah, well, as I was saying, look, I think that these big shifts in currency regime, like the one after the end of the Second World War with the dollar replacing pound sterling, you know, th these things can be sudden and they're triggered by major geopolitical events or economic collapses and so on. What we have seen over the past few years is certainly a gradual erosion of the role of the dollar. Look at the share of the dollar in world trade. Look at the share of dollar in world reserves. Yeah, it's been diminishing step by step. And in favor of the euro mostly and some other currencies. And that'll continue. Look, I think the question is here if Trump's policies and particularly a major political economic crisis that might follow lead to a very sudden shift in the role of the dollar. That's kind of harder to predict, but one in which the dollar, as you say, kind of overnight loses its role as the reserve currency.
What about the bond markets? I mean, dollar is one thing, the de-dollarization thing, but we've clearly seen some, small heart attacks to signaling possible earthquake in the bond market. The early April, we saw the sort of counterintuitive aspect of bonds reflecting no longer a safe haven. Since then, we've seen sort of the longer term 30-year look very weak in terms of the sales. Is there something greater there? Does that present some kind of a challenge or threat for the oil markets to pay attention to?
Well, look, I think the bond market is absolutely a risk, and I'm reminded of that saying that they've learnt nothing and forgotten nothing. Liz Truss, you may have forgotten that she was once prime minister, writing in the US media now supporting Trump's policies, and of course it was the bond market that did for Liz Truss. The US bond market is a lot more resilient, I'd say, than the UK bond market. But similar kind of risks if the US carries on the same kind of politically and economically irresponsible route, and that absolutely has an impact on the oil market. If there's an economic crisis brought on by a bond crisis, then that has an impact on the oil market too, and that is, I think, the big economic worry that we're looking at here.
Jamie Ingram, managing editor at the Middle East Economic Survey, sort of looking to the immediate ahead of us, Jamie, the OPEC Plus due to meet at the end of this week, at the weekend, to make a decision about July output. I was at MPGC yesterday, and everybody, on the stage, there was not one but multiple sort of predictions as to why OPEC Plus was doing this, accelerating the increase of supply into a clearly demand weakness environment where the overhang supply exceeding demand this year was on the stage by multiple voices. Everyone was greater than 1 million barrels, where supply was exceeding demand in 2025. Some as far as 2, some as in the low ones, but inevitably a significant. Your thoughts on the decision they faced this week and where they're likely to go?
Thanks, Sean. Yeah, as you say, a lot of important OPEC meetings this week, kicking off today, but extending into the weekend, where the most important one of all, which is the 8 members who are implementing involuntary cuts, will be discussing what they will do for the July production quotas for that subset. Yeah, it's an interesting one. Definitely, when they first announced that they were starting to accelerate the easing of cuts a couple of months ago now, that took everybody by surprise. But the markets, after initially dropping on that news, have been relatively kind to those producers, I would say. Markets have not suffered despite OPEC Plus announcing that they are going to be accelerating the easing of production cuts. A couple of reasons there. Most importantly, I think, is that the markets are pretty switched on to the fact that easing of cuts, that number is one thing, that headline number is one thing. The number that will actually be brought back onto the market is a very different, much smaller number. Couple of reasons there. One is that a number of those 8 producing countries have been cheating, and therefore they are not going to be able to bring more barrels on. Also, OPEC leaders such as Saudi Arabia are trying to increase pressure on some of those countries which have overproduced to compensate for overproduction, which could slightly bring down production from some of those countries. That's the optimistic take. But either way, let's say they go for another 411,000 barrel a day increase. That's probably going to translate into not much north of 100,000 barrels a day in actual production increases. Then when we factor in increased domestic demand in the Middle East because they burn a lot of oil for heating and temperatures are rising over summer, the actual impacts in terms of barrels entering the market, entering export markets, is going to be much smaller still. We're likely still going to see a drop in exports from the Middle East of crude oil over summer. So that's really the key decision making issue there. So at the moment for OPEC Plus, you're looking at prices being resilient despite you increasing production. Why would you veer away from that strategy? Where it gets interesting, of course, is the end of the year. Temperatures drop, exports from the region start to increase, especially as the production quotas have increased significantly. Then we might have a bit more of a discussion point over what OPEC's strategy will be for the closing quarter of this year and into 2026, when balances really do look a bit more grim.
David, I mean, on that point, it does look like there's still life in the old dog yet from the point of view of oil demand. And the supply increase, as Jamie mentioned, is not as great as the headline number. We're just coming out of the US Memorial Day weekend, which is typically the beginning of the summer season in the US, the driving season. The US economy, the world's biggest oil consumer, still looks fairly healthy. So on a whole and all, not a bad time for OPEC Plus to be doing what seems to be a counterintuitive strategy?
Yeah, that may very well be right. As Jamie has pointed out correctly, that there is a significant difference between production targets and actual exports. I would fully agree that there is basically barely any country that can actually produce more at this point of time. So one thing I've always admired about Saudi Arabia...
Well, obviously Saudi Arabia and the UAE could.
Yes.
I mean, in terms of, many others can, but clearly they're the two big ones that could.
So what I just wanted to say is what I always admired about Saudi Arabia is that they have been very smart about resetting the floor for future cuts. So evidently the market is not looking particularly healthy, and it is well possible that at some point of time in the future further cuts will be required. And then the question is, from which level do we cut? Yeah. And what Saudi Arabia is effectively doing currently is it's raising its own level for future cuts constantly, significantly. While for the others, anyway, it doesn't really matter. Yeah. But if new cuts are coming in, everybody else will basically be requested and initially may actually well contribute. So I think basically this may be one of the things that is currently going on. Yeah, a resetting of the starting levels for future production cuts.
The idea, Robin, of the speculation as to what OPEC Plus strategy is on the supply side, I may sort of obviously give some indication as to when it might end. Where do you fall down on the thinking of Saudi, of OPEC Plus, in this sort of what appears at least to be a counterintuitive approach to increase supply into a demand weak environment?
Yes, I don't think there's an intention to fight an outright price war here. I don't think OPEC is going to want, or Saudi Arabia is going to want prices to go below 50 and remain very low. So that kind of imply, with a relatively weak demand outlook, that these mega increases kind of pause at some point in the middle of the year. And as Jamie and David have pointed out, okay, we're not actually seeing the full 400,000 each month. It's a lot less because of compensation cuts and countries kind of hitting their limits. Now, this kind of OPEC has got itself into a better place here. I think that in an odd kind of a way, the higher its production is, the easier things become, because some countries will be maxing out. Some countries will be at least hitting their quotas, like Iraq will. At least as its target increases, it'll be meeting its target rather than exceeding it, and then it'll be easier for them to make even the compensation cuts that have been requested. Once you work through that backlog, then you can start seeing real increases again. And then, of course, we haven't yet seen the impact on US production, but I think that's really a critical thing for OPEC, and that'll take a few months to work through. When will these lower prices and when will the impact of tariffs show up in US production slowing down or even falling? Drilling has fallen already, but there's obviously a few months lag before that shows in production. So I think OPEC will want to see that, and that again would be a confirmation of the successful strategy if US production starts flattening out.
Jamie, then again at the MPGC event yesterday, there was some talk and commentary on the stage that this is a structural shift within the context of OPEC plus. Kazakhstan, Iraq, UAE may still continue to be nominal members of OPEC plus, but on practical terms, they've checked out. Your thoughts on this being some kind of moment of change to the sort of overarching commitment to the big idea that's been in place now, not only for obviously OPEC for 60 years, but OPEC plus, which is, the last 10 years or less?
I think what we're starting to see at the moment, Sean, is we're seeing the effect of the OPEC baseline, the OPEC plus baselines really creaking. These were COVID era legacy baselines. 2020, they were set in 2020. Realistically, they were set in 2018. That's 7 years ago now. A lot of those members, these baselines are just fictional now. Some of them, the likes of the UAE and Kazakhstan, have massively increased production capacity since then. So they're chafing at the idea, well, hang on, why are we being restricted by essentially by legacy baselines? 7 years ago, they are not reflective of what we can do today, whereas other countries, they have lost significant production capacity over the intervening period, and they're clinging onto their production baselines just because it would be embarrassing to acknowledge cuts otherwise. So that's why we're seeing this disconnect between the paper announcements and the real physical barrels. That is causing a lot of friction within the group. It's very difficult to manage markets when you're having to rely on fictional capacity figures to base them from. So I wouldn't say that we're seeing, the start of a new era of some of these countries checking out, but what we are probably getting towards the point is where these baselines really need to be fixed. Saudi Arabia has been pushing for this for a few years. If you remember back in 2022, I think it was, there was this idea floated of external consultants coming in, auditing the production capacities of all the members, and that would be the basis for the cuts going forward. That had struggled to gain traction because, again, the countries that have lost capacity don't want these guys coming in. But Saudi Arabia is making a push for that. It's still in the OPEC plus communiques. It might even be in today's OPEC plus communique that they're going to try and sort that out from 2027 onwards. But yeah, that's what for me is the inflection point, is what's OPEC Plus going to do about these archaic baselines that are just complicating the matter.
Let's go to the survey question, which picks up on the opening discussion points, which is how significant are the bond markets that appear to hate Trump's tax-cutting, debt-raising, big, beautiful bill, as it's aptly named. It sounds like something out of North Korea. Should the oil markets hate it too? That's the question. These bond markets are clearly signaling big concern about this tax bill that is very nicely disguised as a big, beautiful bill, but ultimately is full of debt raising. Some calculations as much as $5 trillion added to the US sovereign debt as a result of this tax cutting bill. So the oil markets seem to be a little bit undisturbed as of yet. Should they be? Does this signal a shock to the system that could impact demand? Yes, no, maybe. Yes, no, maybe. Dave, looking at the other big aspect in the sort of backdrop of the oil markets or the first half of the year that has kind of fallen to sort of silent new normal, even though there are some very dramatic events happening, and that's geopolitics. The situation in Ukraine is in some of its worst days ever. Certainly in Gaza, that is the case. And it appears that the Trump-Putin love-in is now over. Your thoughts on where these big geopolitical events are going? Do they present any challenge or concern for the oil markets, or is the oil markets reflecting suitably that these are not relevant?
Yeah, if I may say, I've been skeptical about Trump's day one announcement right from the beginning. And I would generally argue, I think one of the big myths in this context is that Trump is a good deal maker. I think he has never been a good deal maker internationally. Um, and yeah, the point I think overall is very simple. Yeah, the U.S. policy is not reasonable. Yeah, generally speaking, I personally would argue that pretty much everything they do is bad for the economy. Yeah, at least in the short-term horizon. Of course, you can buy into the long-term story or not. I'm doubtful there as well. But I think in the short term, there is not much to discuss there. Yeah, I think everybody agrees what the U.S. administration is doing is bad for the economy, their own economy primarily, but with that, evidently for the world economy as well. And this high level of uncertainty and unreasonability is reflected in all these economic indicators and in bond markets. And of course, politicians will come to the White House occasionally and smile and try to appease Trump. But what they do at home is to detach their economy from the US economy, yeah, as much as possible. And that will have an impact on the market along the line. Yeah, it's not the type of factor that will drive the oil market directly into collapse. Yeah, because it's too much of a separate type of thing.
And it can't happen that quickly to detach from the US economy. That takes quite some time. Robin, just picking up on that, on the geopolitical point, the big factor for the oil markets that continues to be debated is, can a deal be done with Iran? What's the outcome of the talks that have happened so far? The mood music seems positive, but yet the sanctions keep getting more and more restrictive. Your thoughts on the outlook for the Iran talks and the impact on their oil exports?
Yeah, so I think a few factors there. The Trump administration, big divisions within it on how to deal with Iran. You have some hawks there. You have Trump himself, who would very much like a deal. Agree with David that he's not a great deal maker, but I think that actually might work in favor this time, because he may be actually, in a weird way, willing to give up more to Iran than a more structured administration would. So the Iranians, may actually get a decent deal out of this if he's quite keen to have some win. He's not going to get one in Ukraine. He's not going to get one in Gaza. So maybe Iran is the one way he can get his big announcement.
How does that square with Israel then? Because that seems to be a big sort of wild card for the US administration in doing a deal with Iran.
Yeah, but Obama and Biden were always running scared of the Israeli lobby, and and that really constrained them. I think Trump does whatever the hell he wants, and he knows the Republicans will fall in line with that, and will be very prepared to praise whatever deal he comes out with. So and again, in a strange way, he's kind of less constrained. So that may work in favor of a deal, even though you'd say objectively the differences between the two sides on enrichment, and Rubio and Witkoff have said this pretty clearly. And the Iranians from their side have said the opposite. There's a huge gap on whether Iran would be allowed to enrich or not. But maybe they can find some face-saving compromise to get around that. If they do, is there a big impact on the oil market? I mean, 300,000 or 400,000 barrels per day of Iranian oil comes back. It's something. It's not massive. It's only 1 month of OPEC Plus's headline increases. It takes geopolitical risk off the table. I think that helps. I don't think that was playing a huge role in the market anyway, but I guess it makes people a little less worried about a big conflict. So yes, it's kind of mildly bearish for the oil market. I don't think it's a game changer, not in the short term.
Jamie, on to that same point, we've talked about supply increase. Obviously, the OPEC plus, the 8 countries in OPEC plus that are involved in that structured supply increase is well known. But where the sort of guessing game a little bit is where else supply increase can come from. We've just heard there from Robin about Iran may or may not be impacted, but on the margins. What about elsewhere? I mean, yes, again, referencing the MPGC just because it was a lot of talking heads yesterday, but there was some talk by a senior analyst there from the US indicating that the US production could fall by as much as 1 million barrels this year.
First off, yeah, I agree absolutely with what Robin was saying there, especially in terms of potential extra 300, 100,000 barrels a day from Iran, maybe over a 6 month sort of period, it's not really going to move the needle. 1 million barrels a day lost from the US over a 1 year period. That is a lot steeper than anything that I have heard from elsewhere. I think that's fair to say that's on the
Well,
pretty
it's
hardcore
basically
side.
based on the premise that given the shale manufacturing architecture, that you have to keep pumping serious money in there, and if you pull back even a little bit from that spend every day, every week, that it has quite a significant impact on sustaining production capacity.
Yeah, and it's very much the short cycle investment that we're talking about when it comes to US shale. I still think 1 million barrels a day is
big
very
number,
much on
yeah.
the high side. But yeah, definitely. We could still be talking about small. We could potentially still be talking about small amounts of growth still coming out of the US as a whole, given investments that have already gone in this year. I think that my gut feeling would be that we're on small to no amount of loss from the US over the course of the year. Yeah, 1 million seems steep to me.
But flat nonetheless is
Flat nonetheless. Yeah, I don't see, and I don't think that OPEC expects to see significant volumes coming out of the US this year.
May I come in quickly?
Please, David. Yeah.
Yeah. One figure that I find pretty interesting in our data set is if you look at all American crude exports, so not only the US, all American countries, including Brazil, Guyana, and all these players, on a 12-month moving average basis, these exports have been flat for the last 5-6 months. Yeah. So effectively, the entire American continent is not supplying.
Which has been the source of the biggest supply increase in recent years.
In the past, 22, 23, exactly. Yes. But it's not anymore the case for quite some time now. And that's also something that is helping OPEC currently and is keeping prices in check, because basically we're in a market where demand disappointments are reasonably well aligned with the supply disappointments. Yeah. So the market is actually reasonably well balanced.
And it's probably also a region of the world most vulnerable to $60 oil. Its production costs are relatively high, and at 60 on WTI, that would have a big impact on investment into the ground. Just finally, Robin, something I wanted to get your insights and thoughts on. The first half of the year started with a very negative bearish sentiment around China and its economic growth, and its sort of set 5% growth target for the year. But yet it sustained its imports of oil at a fairly historical 5-year average levels, 11 to 12 million barrels a day. Your thoughts on China continuing to be a serious pillar for the oil markets, hence the $65 Brent?
I think China's certainly supporting that 65, and if that pillar falls, then then the 65 has a problem. I think the Chinese economic figures, maybe a little bit more optimism on that now. Look at the other commodities, and the results are mixed. It's really hard to come up with a strong narrative either way. I'd say overall the other commodity figures on the Chinese economy are not bad. Not great, but not bad. So overall that kind of, I think, short-term oil picture is looking for China is looking okay. Obviously, the longer-term picture is pretty negative, because of the growing rise of electric vehicles and natural gas powered trucks, and the petrochemical overcapacity. What time does the petrochemical sector just stop this expansion? That's been the key driver of growth in Chinese demand, while the transport sector has fallen away. But short term is still okay, I would say.
Yeah, it's one thing to keep an eye on, a proxy there being the Australian economy, which of course exports a lot of those heavy raw materials, iron ore, etc., into the Chinese economy, and where the heavy industrial activity takes place. So here, yes, should oil markets hate it too? Yes is a big overwhelming number, and we'll see where that goes. But I think it is one to keep an eye on. If this bill passes, how big of a shock with tariffs still to play out? We're 60 days into a 90-day suspension. Could you get both of these things coming in the same window? The passing of the bill of tax cuts and the tariffs re-emerging at the same time. How big a shock would that be? Thank you so much, Jamie Ingram in the UK, David Weck, I think also in the UK, and Robin Mills here in Dubai. We've got an interview coming up with the outlook for Egyptian oil and gas, particularly gas. A lot of duress in Egypt these days around the gas production and domestic gas requirements for power generation. Egypt back being a net importer, significant to see how Egypt plays, particularly now that the Gulf states are going through a period of lower oil revenue, their ability to be generous with their neighbors and support as they have in the past, with billions of dollars being deposited into central banks and so on whenever they're under duress. Will they be able to sustain that through a period of lower oil price? So things to keep an eye out on the margins. Thanks, everybody. Catch up with you all again soon. Have a good week. Bye-bye.
Bye.
Many thanks.
Thank you.